I think Wall Street has most Americans completely hypnotized and completely trained. It's a sad state of affairs. And the scariest part, in my opinion, is they don't even realize how they've been hypnotized, how they've been trained. And spoiler alert, it's benefiting Wall Street more than it's benefiting most Americans. So let's get into it. I want to protect you. I want to help you understand what might be going on that you don't even realize. And we're going to talk all about it in this week's episode.
Welcome to the Secrets to Abundant Living podcast. Your guide on this journey is Amy Sylvis, ready to unlock the keys to a life of true abundance. We're diving into everything from financial freedom and optimal health to meaningful relationships, geographic freedom, and everything in between. It's about creating a life rich in experiences, purpose, and joy. If you're ready for the secrets to an abundant life, hit that subscribe button now, and let's get started.
Secrets to Abundant Living podcast community, welcome to another solo episode. I'm so excited to see you all here. Things look a little bit different here on the podcast today because my husband and I have recently moved and I don't have my podcast studio set up. So I've got my laptop here that I'm kind of hunched over. I've got my microphone over here. You can see it. Let's see if it comes to the screen. There it is. Ta-da! It's a totally different setup. But we're making it happen, right? Because moving is a zoo and unpacking and doing all the things is crazy, but I still have ideas and thoughts and exciting things I want to share with you all. So we're not going to miss an episode. But, please know, I'm not complaining. I feel very grateful to have a roof over my head, to live in a safe place, to be with an amazing husband and all of those wonderful things. So not complaining on this end, but yeah, things do look definitely a little bit different, but we're making it happen. For those who don't know me, my name is Amy Sylvis. I'm the founder and CEO of Sylvis Capital. We connect investors to hands-off real estate investment opportunities. And I love to talk on this podcast, especially these solo episodes, about ways we can increase our financial independence. And as you know, but I love to say it anyway, the goal of financial independence isn't to just have a whole bunch of money and sail off into the sunset. The goal is to be able to buy back our time, to be able to have overflow so we can contribute to causes that care about us, so we can spend time with people we care about, being able to not have to ask for time off, so we can take care of loved ones, so we can contribute to society in a way that aligns with our values. So that's what we love to talk about today. And I recently wrote a LinkedIn article about this, but I wanted to talk about it here because I'm just so passionate about it. And I think Wall Street has most Americans hypnotized, myself included, up until probably, maybe 10, 15 years ago. And so what in the world do I mean about that? What does that mean? Here's what it means. Most Americans are told to go to school, get a job, and in that job, open a 401k with your employer and contribute every month, right? Because you're a fool. You got to start early. You're a fool if you don't start this process early. Time helps to compound that interest and that investment. And oh, God forbid you lose out on that employer match. For those who aren't watching the video, I'm wagging my finger at you all. So that's what we're supposed to do, right? What a boon for Wall Street. Imagine you're Wall Street and you've convinced tens of millions, hundreds of millions of Americans to automatically wire you money in their retirement account into Wall Street. That's a pretty powerful marketing strategy, right? That's pretty amazing. They get new investment money every single month. And hey, I'm not saying stocks and bonds are bad. I'm not. I'm definitely not. As we've talked about many times here on the podcast, you all know the wealthy invest differently than the way the middle class are told to invest, right? The middle class, data, study after study shows, they have most of their wealth in their retirement accounts, and most retirement accounts only allow stocks, bonds, and mutual funds. And they convince people that their wealth is diversified if they're in just paper assets. Spoiler alert, You're not diversified. That's not what diversification means. If you're all in one asset class, that's not diversification. But middle class, they have their wealth in their retirement accounts, which are in stocks, bonds, and mutual funds. Then their primary residence, right? Their owner occupied primary residence. And maybe if they're lucky, they've got a pension, a defined benefit pension from their employer as well. And that's it. Meanwhile, the wealthier out there, truly diversified, right? They're invested in assets whose performance isn't necessarily correlated with the other assets that they own. So they own gold and silver bullion. They own private equity. These are companies that aren't publicly traded in the stock market. They own commodities like actual oil and gas, not stock representations, but actual oil and gas. They own real estate that, where they live. They're not owner occupied real estate. I mean, they own that as well. I'm not saying the wealthy don't own their own home, but they also own real estate that produces passive income every month. So we're out here trying to be like the wealthy, trying to have wealth like the wealthy, but we're investing completely differently. Think about that for a minute. And we're told to just hand over our money to Wall Street. So I think that's a hypnosis. Now, I'm not saying that stocks, bonds, and mutual funds shouldn't be a part of your portfolio. I do not give financial advice. I give education. But what I do want to make sure is that you're examining the financial advice that you've been given by society, by financial planners, and you're deciding if that aligns with what you want to invest in, if that aligns with your goals. And for some people, being in stocks and bonds and mutual funds is great, but they also want to diversify. So if, God forbid, stocks, bonds, and mutual funds go down, some of their non-correlated assets go up to smooth out their portfolio. We've talked about this on the podcast. But if you're all in assets that tend to go up and down together, God forbid, something tanks, it's a problem. So I talk to people. I have the blessing and the privilege to talk to people that are examining the other asset classes that the wealthy invest in, like I mentioned. But some of the feedback that I get from people, and this is where I think, again, the hypnosis happens as well. The feedback that I get is, well, there's no guarantee in these other assets. How do I know if this is a good idea to invest in? Or, oh my gosh, there's fees associated with these other investments. I don't want to, why am I paying fees? You're being gaslit because you may not realize, you may not have read the prospectus of your mutual funds in your 401k, but let me tell you that performance is not guaranteed either, and you're paying fees as well. So let's get into it because, again, I'm not saying one asset class is better than the other, but I don't want you to halt your progress to financial independence. And as you're examining other asset classes to invest in, that the wealthy invest in, that you're deterred by something that you think is different or you think is a red flag, when in reality, it's just true of the entire investment space. Have you ever thought about having multiple streams of income? Instead of relying on just one stream of income where you're trading your time for money, how would you like to free up more of your time and live a more abundant life? As a listener of the show, you're invited to attend one of our upcoming trainings where I'll give you an inside look into how you can add passive income and get all the other perks of recession-resistant real estate investing without the headaches of being a landlord. I'll also be sharing some hidden mistakes to avoid and the criteria I personally look for when evaluating potential investment opportunities. To reserve your seat for free, go to sylviscapital.com/webinar. Again, that special link to reserve your seat for free is sylviscapital.com/webinar. I look forward to seeing you on the training. And now back to the show. Okay, let's get into it. So when you invest in a mutual fund in your 401k, there's a mutual fund prospectus, and it's a legally binding document governed by the SEC. So what you'll find there is that you as the investor are taking all of the risk. The fund manager, the manager that picks the stocks and the bonds that go into that mutual fund, if it's an actively managed mutual fund, they take on none of the risk. If they make bad picks and lose money, there's no recourse that you have as an investor. Too bad. You just lose, right? That's just part of the game. So loss of money is a risk of investing in the fund. You'll see that in the non-recourse clause for mutual funds. So the fund is not a bank deposit and is not insured or guaranteed. So again, if the fund manager makes these picks and they're bad and the market goes down, or if the entire market just happens to go down, there's nothing you can do as an investor. Now, I'm not saying, oh gosh, that's a red flag. That means you should never invest in mutual funds. The wealthy invest in mutual funds. Stocks and bonds can be a great part of one's portfolio. I never give financial advice. This is just education. But what I am saying is if you happen to see similar language while investing in private equity or in real estate or in commodities, I don't want that to deter you on its own. It's good to be skeptical. It's good to investigate, but just know that also exists in your stocks and your bonds and your mutual funds. It's just part of the game. And I want to make sure you're aware. I think there's this idea because everyone's doing it. Everyone's investing in mutual funds. There's this false sense of safety and security that, well, if everyone's doing it, it must be fine. And, maybe there's not as much risk. I haven't heard of, you may be saying this, or I've heard some people say, I haven't heard of a lot of people investing in real estate or private equity or gold and silver bullion. That must be more risky. So I'm going to take a more skeptical view, or I'm going to do even more research on alternative investments because I'm scared. By all means, do all of the research, but make sure you understand what you're comparing to. And I think there is this general lack of knowledge about what we're agreeing to when we invest in mutual funds as well. So, and the same goes for your financial planner, by the way. So a fund manager is someone who takes a fund that you invest in and picks the stocks and bonds and mutual funds and manages that. That's an actively managed mutual fund. Then you also might have a layer of a financial planner that you go to, and the financial planner picks the mutual funds for you to invest in. There's no recourse there either, by the way. So regardless of how their performance is, how they advise you, there's no recourse there either. So the other thing is this fee structure. These mutual funds, there's actively managed, there's index funds. Index funds don't really have as high of fees because they're designed to just mimic a group of stocks like the S&P 500 or the Dow, et cetera. There's still fees, but not as many. But in an actively managed mutual fund where they're analyzing and picking stocks and et cetera, et cetera, et cetera, you're paying fees to them every month that can be large. There could be management fees, there could be expense ratios, and sometimes you're even paying a fee so the fund can market itself. There's called 12B1 fees. So you're still paying those fees if the mutual fund performs well or if it doesn't. You're still paying the fees to the fund manager and also your financial planner, whether things perform well or not. So look, we can't change the industry. It's just what it is. But I want to make sure that you're aware that performance is not tied to compensation in this mutual fund and financial advisor area. Now, it's the same most likely when you invest in alternative assets. So I'm not saying alternative assets are better and trying to put down stocks, bonds, and mutual funds, but I do want you to be aware and have this idea of performance and fees and, gosh, what's the word I'm looking for? Kind of recourse to not deter you from exploring this area, from not exploring these alternative assets that could be a nice addition to your stocks, bonds, and mutual funds. I've seen it happen too much. And again, my goal is to provide information and context so that you're not scared off by something that could make a large difference on the positive end. And again, it might not be for you. You might say, Amy, stocks, bonds, and mutual funds, they're all I need. They fit exactly what I'm looking for. Perfect. Excellent. Also, you're still paying fees, but you will if you're doing private equity, if you're doing oil and gas, if you're doing real estate as well. So I don't want you to get hung up on the lack of guarantees or the lack of fees in any of the types of investments that you're making. So look, the wealthy are growing their portfolios through alternative investments. They're going to continue to invest in commodities. They're going to continue to invest in private equity and private lending and real estate. It's really up to us to fully examine the risks, but also understand the benefits and understand where we want to go with our portfolio. So I don't want you to get stuck with this Wall Street hypnosis. There's nothing wrong with Wall Street. but just defaulting every month for your retirement or your entire wealth portfolio to just contributing to Wall Street stocks, bonds, and mutual funds, it may, hear me, it may not be the best fit for your goals. So it's a little bit of a sassy episode. This may seem a little sassy for you all, but I'm not afraid to, make sure that no one's pulling the wool over your eyes to make you think that there's something magical and sacred and extra safe about a certain asset class. There is a reason the wealthy do what they do. And while it might not be a perfect fit for you, I would argue, it's worth your time at least exploring what else is out there that you can invest in that might help you get to your financial freedom, if that's what you're looking for, your financial independence. All right. This has been a lot of fun. We actually did this without our normal podcast studio. So thanks for hanging in there with me. I'm really excited to continue to provide you all with more information on how to reach your financial goals. And as always, if you could give us a review, that would mean so much. We put a lot of time and effort into this, even while we're moving. And giving us a review helps us reach more people and spread the great word. All right, y'all. I'll talk to y'all soon. Take care.
Thank you for joining us on another episode of the Secrets to Abundant Living podcast. We hope you found inspiration and valuable insights that will empower you on your journey towards abundance. If you enjoyed today's episode, don't forget to subscribe, rate, and leave a review. Your feedback means the world to us, and it helps others discover the secrets to an abundant life too. Stay connected with us on LinkedIn, Amy Sylvis. Keep striving for your goals, nurturing your relationships, and embracing the adventure that is life. Until next time, we wish you an abundantly fulfilling day.